Welcome back to The Explainer. Today, we're jumping straight into the Jio Platforms Draft Red Herring Prospectus, the DRHP, to uncover the real story behind their cash flow and capital intensity. We're going to cut through all the noise and look exclusively at the financial bedrock of this digital giant to see exactly where the money goes.
So here is the central question we're answering today. When a company boasts multi-billion rupee valuations, it is so easy to get totally lost in the top-line hype. But we're peeling back the layers of Jio's accounting to see how much of their reported profit actually turns into cold, hard cash in the bank. And crucially, we need to know how much of that cash has to be immediately reinvested just to keep the lights on and the network running.
Here's our roadmap for today. We'll hit profit is not cash, the cash flow engine, the heavy cost of growth, calculating free cash flow, a 3-year cash scorecard, and finally, the core investor question.
Okay, starting right off with Section 1, profit is not cash. When you're reading financial headlines, you usually see terms like PAT, profit after tax, and EBITDA. Now, EBITDA acts as the sort of headline hero, right? It shows operating profitability before accounting for things like interest and taxes. But at the end of the day, it's really just an accounting metric. On the flip side, actual cash generation metrics, like operating cash flow and free cash flow, well, those are the quiet workhorses. They reveal the real cash moving in and out of the business, and most importantly, the actual cash remaining after essential investments.
To bridge that gap between accounting profit and actual cash, we really need to strictly define a term exactly as the DRHP outlines it, and that's cash Capex. The document defines this as the cash outflow towards expenditure for property, plant and equipment, spectrum, and other intangible assets less disposal proceeds. This isn't just some hypothetical number on a spreadsheet. This represents the actual cash draining from the business to fuel and expand its massive digital infrastructure.
Moving on to Section 2, the cash flow engine.
Think of Jio's financials as a massive industrial funnel. We start way at the top of the income statement with revenue. From there, we filter down to EBITDA to see operational profitability. But then we actually have to adjust for working capital, the day-to-day money tied up in the business, to get our actual operating cash flow. From that cash, we must subtract our capital expenditures, or Capex, which is the money spent on physical and digital assets. Only then do we finally arrive at free cash flow. That's the true internal cash generation of the business.
And just to be absolutely clear about where we're getting our data, we are pulling these massive figures straight from page 396 of the DRHP's restated consolidated cash flow statements. We aren't forecasting, and we certainly aren't estimating. This ensures absolute documentary credibility as we analyze this cash flow engine.
So what does that DRHP data actually show us? Well, it reveals an incredibly impressive upward trajectory in operating cash flow. In fiscal 2024, Jio Platforms generated roughly 576 billion rupees in net cash flow from operating activities. By fiscal 2025, that jumped to over 681 billion. And in fiscal 2026, it surged again to over 775 billion rupees. The cash coming through the door from actual business operations is consistently and significantly growing.
What's really interesting here is how working capital movements aid that cash generation. The DRHP specifically notes that in fiscal 2026, there was an increase of over 35.4 billion rupees in trade and other payables. So what does that mean in plain English? Basically, it means Jio held onto its cash just a little bit longer before paying its suppliers, which temporarily kept more cash within the business.
Which brings us to Section 3, the heavy cost of growth.
Generating all that operating cash is really only half the story. In stark contrast to the rising operating cash flow we just talked about, cash Capex is actually trending downwards. In fiscal 2024, cash Capex was a staggering 535 billion rupees. But by fiscal 2025, it dropped to about 442 billion. And by fiscal 2026, it fell even further to roughly 341 billion rupees.
So where is all this money actually going? According to the disclosures in the DRHP, this heavy reinvestment is primarily driven by 4 key things: investing in property, plant, and equipment, capitalizing spectrum, acquiring intangible assets, and the ongoing development of their standalone 5G network. The document notes that fiscal 2024 Capex was particularly high because of heavy investments to develop that 5G network, which completely explains the downward trend in subsequent years as that initial heavy lifting was completed.
To firmly highlight why EBITDA isn't cash, we need to compare depreciation to Capex. Let's consider fiscal 2026.
The accounting expense of depreciation, which, remember, reduces reported profit but doesn't actually cost cash that year, was roughly 272 billion rupees. However, the actual cash reinvested into the business as cash capex was significantly higher, at nearly 342 billion rupees. You can clearly see why looking only at accounting profitability can completely mask the true capital intensity of a telecom and digital network.
All right, Section 4, Calculating Free Cash Flow. With billions coming in and going out, how much internally generated cash actually remains? Now, it's important to note that the DRHP does not explicitly report a single, consolidated line item called free cash flow. However, we can calculate this incredibly vital analytical metric using the exact figures they do provide. We simply take the reported operating cash flow and subtract the reported cash capex.
Let's actually do the math for fiscal 2026. If we take the 775.5 billion rupees in operating cash flow and subtract the 341.8 billion rupees in cash capex, it yields a massive calculated free cash flow of roughly 433.7 billion rupees. That is the actual internal cash the business generated after paying for its vast infrastructure investments for that entire year.
Let's put this all together in Section 5, our 3-year cash scorecard.
Bringing all these reported facts together absolutely proves the narrative. Just look at the trends across the board. Accounting profits and operating cash flow are both surging, while capital expenditure is tapering off. This gives us massive insight into Jio's cash conversion. If we compare the operating cash flow of 775 billion to the EBITDA of 762 billion in FY26, the cash conversion ratio is actually over 100%. They are converting virtually all their operating profit into actual cash. And the bottom line result? The net increase in cash for the company is dramatically accelerating, jumping from just 14.5 billion in FY24 to over 85.4 billion in FY26.
Finally, Section 6, the core investor question.
We need to be very clear about what the document explicitly proves versus what it just suggests. The DRHP strictly proves that operating cash flow is rising annually. It also proves that capital intensity is dropping dramatically. Cash capex as a percentage of revenue literally fell from nearly 49% in FY24 down to just over 23% in FY26. Analytically, this suggests a major shift toward a highly cash-generative, self-funded profile. However, what investors absolutely must continuously monitor are future spectrum requirements and evolving 5G network expansions, because the DRHP explicitly states that new regulations or technologies may require additional heavy investments down the line.
Which leaves us with the ultimate question. Based on this precise data waterfall straight from the DRHP, what do you see? Are we looking at a self-funded cash machine that has finally cleared its biggest infrastructure hurdles? Or is an enterprise of this immense scale forever tied to heavy, cyclical capital demands just to maintain its competitive edge? The numbers are all on the table. Thank you for joining me for this explainer, and I'll catch you in the next one.